After a positive start to the year, we saw share markets give up their early gains in what was a highly volatile end to January. Growing uncertainty around the deployment of vaccines, combined with the fallout from the Reddit-GameStop saga, weighed down on returns in developed markets, including Australia. However, we did see emerging markets enjoy another strong month, as countries such as China, Korea, and Taiwan continued to lead the charge in their economic recoveries, following their superior handling of COVID. We also saw bond returns fall slightly, after 10-year Treasury yields surpassed 1% for the first time since March. Well, it might be a new year, but US politics was still hogging most of the headlines in January. Perhaps of most significance was the shock result out of Georgia, where the Democrats won both available seats in the crucial runoff elections, effectively giving them control of the Senate. This result has massive implications for Joe Biden's legislative ambitions, and now gives him greater scope to push ahead with his policy agenda. Wasting little time, Biden has already proposed a $1.9 trillion American Rescue Plan, designed to boost the economy until the COVID vaccine is widely available. It's also expected that he'll eventually push for higher taxes on both companies and high-income earners, greater antitrust regulation in the dominant tech space, and stronger action in relation to climate control. While each of these measures are likely to have a significant impact across various sectors, the market's main focus to date has been on the stimulus package and the anticipated shift to a greener economy. Another topic that's been widely discussed in January is the possibility of an imminent pullback in the share market. The extended rally following the March COVID lows has driven traditional valuation measures like the price-to-earnings ratio to well above average levels, generating fresh concerns that the share market has become overvalued or expensive. However, when we're comparing company valuations over different time periods, it's important we consider them in the context of what the market conditions were like at that point in time, particularly interest rate conditions, which can have a material effect on the valuation of a company. The yield gap is a measure that's often used to better understand company valuations in varying interest rate environments. It simply compares the earnings yield available from owning shares to the yield available from owning 10-year Treasury bonds. Over time, we expect this premium to be somewhat consistent. An above-average yield gap tells us that shares are relatively cheap considering interest rate conditions, while a below-average reading suggests that shares are relatively expensive. If we observe the yield gap in Australia and the US over the last 20 years, we can see that both markets are currently just above their average of 2.5%, suggesting that share valuations today may still be appropriate given the current interest rate and bond yield environment. Thank you for watching. For a more comprehensive market wrap, please visit the Capital Partners website.